Welcome, family, to another edition of the Small Money Big Dream vlog. Today's topic I would like to discuss is price earnings ratios. Now, you'll hear a lot on different investment shows, or you hear market people talking about PE ratios, price earning ratios. And I want to basically tell you what a price earning ratio is. It's basically the market value of the share divided by the earnings per share. And what that basically saying to you is, for what the stock is selling for, or how much the stock costs versus how much money is being earned per share, how much of the earnings per share is compared to what it's cost. So basically, on a more simplistic level, it's used as a multiple of how much money does it cost to basically get back, earnings of a company. So a rule of thumb is that's like a P ratio of 20 means that for $20 you get back $1 of earning from that company. And that's on the most simplistic level. So now you're saying to yourself, you're scratching your head, why would I want to pay $20 to get back $1 of earning? And that's just a ratio and perspective of how valued the company is for future growth. And high PE ratios are usually a sign that there's a high growth potential for a company's revenue to grow, company's earnings to grow, and that's why you're investing now for future growth, to reap the benefits of the future. And the reason why you'll hear in my previous vlogs that I always say I look for a PE ratio of 10 and under, and it's just like PE ratios are not all created equal. And I want you guys to, if you don't take anything from that, one thing I do want you to understand that PE ratios value from industry to industry. Technology companies, the tech stocks, the Apples, the Googles, and stuff like that. Apple. I'm not going to use Apple as an example. I'm sorry. Let's just say the Googles, the Yahoos, the internet-based companies, the Amazons, even the eBays and stuff like that. They usually have high PE ratios because those companies' values are based so much on hype and how popular they are versus how much money they're really making. Amazon stock in history, there was times where the shares was huge and the company was barely making profits. And I'm not scaring you away from Amazon. I'm just saying the PE ratios for some companies have been 60, 70, 642, ridiculous numbers. Is basically saying a 642 ratio is saying you paying $642 for $1 of earning. And a PE ratio of that crazy is just saying that the belief in this company's future growth is so great that you want to buy into all the hoopla. And the reason why I recommend the low PE ratio, and I usually look for a PE ratio under 10. To me, it's saying it's saying this: the price of this stock versus his earnings, it's closer. And to me, that signifies this. What I'm paying for the share makes more sense to me because they're making this amount of dollars. So when you have those high PE ratios, people say, oh yeah, you got to think of the future. But to me, I think stocks with higher PE ratios are more risky because it's just like you're paying in the hopes that this high PE ratio is really going to really bring in that money or that future growth that it's saying. And to me, the future is so unpredictable, and I feel like I'm not preaching for investors to be conservative, but I want investors to just be cautious because people, use the term of being experts or my analysis, and if they use fancy enough words, it just makes you buy into it. And my goal is to simplistically explain to you what this is meaning. So the reason why I like a PE ratio of 10 and under is because to me it's saying that this stock is selling closer to what makes sense to me. And a utility companies who have steady income, steady revenue growth will have a very low PE ratio. So you can't compare a utility company with a technology, because technology is always on the advancement. Who's going to break through? Who's going to make that new product? Who's going to change the game? And that's why it's a different form of PE ratios. So when you want to compare PE ratios from company to company, make sure you can't compare Yahoo's PE ratios to Keyspan or National Grid or Con Ed or whatever utility company, or Georgia Power, whoever's your utility company. You can't do that because they're two different sectors. You want to compare from sector to sector how the PE ratio of the stock you're looking at is doing. And so, in a nutshell of the PE ratio vlog, I'd like to say, the average PE ratio of companies all across the market is 15. And the reason why I like a below the average, 10 is my number that I like, is because to me it's like, if you find a stock that fits all your criteria as far as the market cap, it being a large cap stock, it has a lot of volume, which means there's a lot of interest generated in that stock, and the value price of that stock is what you want to pay, so probably, like I said, we concentrate on between $0 and $10, and you see the values there, the market cap is there, and it's possibly outperforming the market. And then you see the PE ratio is 10. To me, that's a stock that I would go with, because it's just like all the criteria that I like is there, and the PE ratio is telling me that I'm paying for a value stock versus a growth stock. A stock that's trading at a volume right now and then over growth. Because I feel traditionally value stocks at this time can become growth stocks. So why completely invest hoping that one day, the growth that people are promising does materialize, versus the value that you recognize now, translating into growth. So PE ratios is basically, the price you'll pay for the earnings of a company. And that'll wrap up my PE ratio vlog. I hope that, gave some clarification for people for what a PE ratio is. And like I said, the rule of thumb is you can't compare PE ratios from companies from different sectors. You got to compare companies that have likewise business models. But to me, the magic number for PE ratios for me is 10 and under. Because the average is 15, but I'd like 10 and under. 10 and up under is close to making sense to me, and it's recognized a good value. Once again, you can reach me at smallmoneybigdreams@gmail.com is the email. The website, like always, is smallmoneybigdreams.com. And once again, I'm your host, Morvin Spanam. Thank you for tuning in, family, and look towards more upcoming vlogs that can help you out. They'll be titled by different titles of what I'll be discussing. And I'm here to help people with small money accomplish big dreams. Signing off, people. See you at the top.